Good morning. I'm Simone Del Rosario, the Straight Arrow News business correspondent. We are minutes away from the September inflation report. But before we get to that, I just want to say that we are thinking of those who are in Florida today as Hurricane Milton made landfall last night. So we're hoping for safety for everyone who is there in Florida right now. And of course, for our first responders as well, who are helping people in those areas. And we're going to be talking about how these back-to-back hurricanes that have hit this region might be impacting the economy as well. As I mentioned, we are minutes away from the Consumer Price Index report coming out for September. The expectations right now is that inflation is at 2.3%, which would be the lowest mark since February 2021. Very, very close to the Fed's 2% target. However, core inflation is still expected to be higher at 3.2%. I want to bring in my guest today. Chris Konstantinos is the managing partner and chief investment strategist at RiverFront Investment Group. Chris, good morning.
Good morning. Thanks for having me, Simone.
Yeah, we're obviously here to the economy. We've got an active hurricane. We've got active storms going on in Florida. We're going to be keeping that in mind as well as people are dealing with that. But there are going to be a lot of economic impacts. As we get ready for the inflation report to come out this morning, what are you looking for?
Yeah, sure. One of the things I like to track is the Cleveland Fed does a sort of nowcast for inflation for CPI, which I find really helpful. It's very similar to like the Atlanta Fed and what they do for GDP. And when you look at what they're expecting for September, their numbers are actually a little bit lower than where consensus is, not by a lot. I think they're annualizing at maybe 225. My expectation is this is relatively benign. This will be probably a report that won't change the Fed's mind one or the other too much. But again, forecasting is a fool's errand. So, there's always room for us to be surprised.
Of course. I'm looking at what traders are looking at right now as far as what the Fed might do in November, right after the election, is that meeting. The majority think there will be a 25 basis point cut. Some people are in the no cut territory. So that's kind of interesting to see.
Yeah, what's been really fascinating to watch is over the last week or so, the probability of no cut in November went from like 0% in terms of how the bond market's pricing the probabilities to now somewhere roughly, let's call it 25%, one in four. I think that's
Mhm.
fascinating. That's a pretty big jump in probabilities. I think it has a lot to do with the really hot employment data we've seen, and also the fact that if we're when you take a step back and look at the U.S. economy, the services part of our economy is still going gangbusters. It's still expanding at a
Yeah.
pretty rapid rate. A lot of people focus on the manufacturing side, which is really struggling. I'd argue we're kind of in a mild manufacturing recession as we speak, but many people forget that the services side of the U.S. economy is just a much larger part now than it was in, say, the 1950s. So if services keeps rocking, then the overall U.S. economy is likely to stay out of recession, and that's likely to keep the Fed very data dependent and not too eager to overcut, if you will.
Yeah. What did you think about that jobs report that we just got? We had a massive beat in there, 254,000 jobs added. It was more than 100,000. The median estimate from economists. There was wide ranges in estimates, but even the highest end of the range did not reach how many jobs showed up in that report. What did you think about it?
Yeah, a couple notable things about that. First of all, always have to keep in mind that this data, these payrolls data, it's highly volatile, right? And
Yeah.
over anchoring on any one data point, I think is not a great idea. I think you kind of have to just look at the trend. But when you step back and look at the trend is clearly that the employment market in America writ large is still pretty healthy. Now, obviously, that has a big sector component. Certain industries, tech, for instance, is I think in a continuing to be more in a mindset to lay off after the
Mhm.
huge increases in employment that they saw during the pandemic. But then there's other industries that are still very much trying to hire as much as they can. Um, just a historical note here: when you step back and look at a 250,000 person payroll number, um, there's only been a handful of times in history, I believe it was in the 1980s, a couple times in the 1980s, where the Federal Reserve was embarking on rate cuts at a time when the job market was as good as it is today. And if you look at those times, those were times when the US economy avoided recession over the next year or two following the interest rate cut cycle. So, I think this remains a pretty constructive backdrop for the economy and for the stock market.
Okay. So are we saying soft landing there?
Yeah, soft landing, no landing is even bantered about a little bit because again, you have a composite PMI in the U.S. of well, over 54, which suggests an
Mhm.
economy that's expanding pretty well. So again, I think the Fed has a really difficult job. Their dual mandate of maintain of trying to keep inflation under check and also maintaining full employment is really hard to do. I think this year
Yeah.
they've done a really nice job of walking that tightrope, but it's a very, very difficult job.
Okay, well, it's 8:30 in the morning, which means that our inflation numbers are out. Per usual, as we live stream this, is we'll be looking down at our laptop sometimes. So as we hunch over, no judgment on my posture here. But here's what we're working with the September inflation numbers from the Bureau of Labor Statistics. The headline number for inflation is 2.4% rise on an annual basis, while the core number is 3.3%. So headline is a little bit hotter than expectations.
Hmm.
Core is also a little bit hotter than expectations. I will add in August, we had 2.5% headline inflation. So this is a slight drop down from that. Price inflation remaining pretty stable, another 0.2% rise on the month for September. That was the same as we saw in August, the same we saw in July. So pretty steady clip right now. But, again, slightly warmer. Let's call it warmer than economists expected for this. Really, really not a lot off the headline numbers, but how do you interpret these so far as I continue to look through what we're seeing here?
Simone, I would agree with your assessment of warmer. I think this was a slight surprise to the upside. I don't know if it's a blowout. I wouldn't know. I wouldn't say that it's something that necessarily is going to change the Fed's calculus dramatically in and of itself. But I think it does point to the facts we were talking about just a second ago, which is that the U.S. economy is continuing to do pretty well overall. And the
Hmm.
Federal Reserve, we know from looking at the minutes yesterday, the minutes that were just released, we know that the Federal Reserve actually had quite a pretty robust debate internally about whether to go 25 or 50 last time. And the fact that they went 50, I think, gives the Fed some leeway to to not have to be quite as aggressive with cuts in the latter half of this year. So, our view internally has been we'll probably get two more cuts this year of 25 basis points apiece. I don't
Mm,
know if this print is enough to throw that off course or not. My initial read is probably not. But nonetheless,
hmm.
I do think the Fed has optionality here, especially if we get another strong payrolls number this Friday.
Yeah. So I'm going to be waiting a couple of minutes, let the traders let that sink in a little bit before I refresh my CME Fed Watch to see what they're thinking as far as rate cuts are concerned. I wanted to point out the shelter index here. Shelter has been the thorn in inflation side for a very long time. It's been running very hot. And we're seeing it fall under 5% this month. So, for an annual rise in shelter prices, we're sitting at 4.9%. So, that's positive news. It rose 0.2% on the month, so starting to rise at a slower clip, I would say. Last month, the annual rise in shelter was 5.2%. So a little bit of a swing down there. This is one of those areas that has really been helping fuel that core inflation much higher than the Fed would like to see it. We talk about the Fed's 2% target, and we see that headline number that's so close to 2%. And you're thinking, wow, look how close they are. Of course, the Fed is talking about core inflation, which strips out energy, which strips out food prices, because those are more volatile. And what we're seeing is the energy index is helping bring down that inflation on the headline side. So in core, we don't have that same downward pressure. And that's why we're still seeing it up in the threes. So let's talk a little bit about that shelter index because, I try to find the silver lining in here. We're under 5% for an annual rise. It's slightly silver, right?
Yeah, sure. I would say it's a silver lining of sorts. I think one thing we need to keep in mind with the shelter component is that it's pretty lagging.
Hmm.
This is one of those pieces. CPI is far from perfect. Even the Fed would admit that. I think in an honest moment, it's a data point that was created a long time ago and arguably hasn't kept up with some of the changes in our economy last few decades. I'd look at the shelter component and say this is a really lagging one for people that have been, in that market. They know that, particularly in certain areas, rent has come down quicker than that indicator had suggested. So you might be catching. It's good that it's in a downdraft, but you might also be catching what's really been known to the market for some time. That's why some of us like to follow higher frequency indicators of rents than what
Hmm.
is going into the CPI number, and we've seen that start to been coming down for some time now. But yeah, no, I think we need to celebrate where we can. Housing affordability is an enormous issue for many Americans, and has a huge impact on consumer spending, particularly at the lower end.
Hmm.
So any kind of relief, quote unquote, we get would be welcome. But remember, the fact that it's going up by less than 5%, it's still going up by more than more than inflation writ large is going up. So it's they're changing the rate of change is accelerating, but that isn't very helpful when you think about pre-pandemic to now, prices are up well into double digits, well over 20% in absolute terms.
Yeah, I gave traders a couple of minutes to let it sit in and just, well, I'll continue refreshing this as we talk more, but just refreshing the CME Fed Watch to see what their thoughts are on November. More people switched over into the 25 basis point camp from no cut at all. So
Hmm,
we had about
interesting.
1 in 4 was the probability for no cut, and now it's 1 in 5. So yeah, we've got an 81% right now probability that we're going to see a 25 basis point cut in November. Based off of what we're seeing right now, and knowing, we obviously still have a lot more data before that November meeting, but are you feeling? You said your group was thinking 25 basis points in November, 25 basis points in December.
Yeah, and I think again, probably nothing that we've seen from this initial read would change that view.
Hmm.
But it's always interesting to get the initial reaction from stock and bond markets, and then it's always interesting, in my opinion, to then look 24 hours later after folks like myself have had time to really digest and think and speak with colleagues and look at our portfolio positioning. And sometimes you get a different reaction. I've noticed this especially with Fed meetings, where whatever the initial response is to whether it's the Q&A or what have you, I generally think take a deep breath, turn your screen off, come back to it in a few hours, come back to it the next morning, and look at it 48 hours later. And then oftentimes the market will have more convincingly made up its mind on whether it was hawkish or bullish than what the initial response is.
Yeah, one of my favorite things is to watch the stock market as Fed Chair Jerome Powell talks. You'll see wild swings happening at that moment as people are digesting every intonation that he makes, every word that he says, and it really moves markets there. And to your point, it kind of settles out by the end of the day. So very
Yeah.
reactionary in the interim. And we are here talking to each other about what these numbers mean, but then of course we will also step back after this talk and think about the inflation numbers a little bit more, and think longer and deeper about what's going on here. One of the things that I am seeing here in the inflation before we move off the report, is that food prices are starting to clip up a little bit. The overall food index was up 0.4% on the month, which would be a much faster clip than being able to maintain a 2% inflation. On the year, food prices are up 2.3%. Those grocery prices still pretty good, 1.3% inflation over the entire year. So for people who had to withstand the really heavy price increases in groceries, especially post pandemic, that while we're still paying higher prices because we're not seeing prices go down, we're seeing disinflation, not deflation. Um,
Right.
1.3% year over year. We're starting to at least get that stabilizer in there. But then you look at like food away from home, where you have the services industry kind of playing into a role there, and it's still up 4%. So the big downward driver here is going to be your energy, and then that core is just kind of sticking pretty hot right now. What would you want to hear from the Fed before they enter their quiet period? We've got almost a month before they're going to meet. So, what would you want to hear from them leading up to that November meeting? And how do you think the election might play a role in what's going on here?
Well, I would like to hear a really calm and measured tone from the Fed. I think that the transmission mechanism, the most powerful transmission mechanism they have, oftentimes, is simply their words, the jawboning, right? Because what they say has such great import into our bond markets, interest rates, our overall financial conditions, which, of course, we're the largest economy in the world, and what we do influences every other central bank in the world, whether people admit it or not. That jawboning influence can be really powerful, and I think what I would like to hear is just a very calm, steady hand at the wheel, because I think, we recognize what the Fed's trying to do is really difficult. And Jay Powell, earlier in his tenure, I think, like many Fed chairmen, made some missteps in terms of not realizing how um, closely every word would be studied, and he was maybe less careful than he should be in terms of how he communicated. I think he's gotten a lot better. But
Hmm.
I would just like to hear a very calm, measured tone, and with allowances made for the fact that the inflation genie is not totally stuffed back in the bottle yet, and to be humble about
Yeah.
that. But on the flip side, also not to sound too strident alarm on the U.S. economy, because the U.S. economy is, in our opinion, still in pretty good shape overall.
Yeah, I want to move on a little bit to the hurricanes right now. We've had Helene, and in less than 2 weeks, now Hurricane Milton is, in Florida now. And Atlanta Fed President Raphael Bostic said that this 1-2 punch, this, back to back hurricane could actually affect the economy for at least 6 months,
Mm.
especially in the supply chain factor. What sort of things could be, immediately impacted in the economy as Florida and, especially other states as well? I'm just thinking Florida because they have the double hurricane right now. So,
Mhm.
how can that be affected, and what is specific about the region there that was impacted and how that might impact trade?
Sure. I'll definitely address that. I just want to take a moment to also recognize a huge human toll. I have a lot of friends in the western part of North Carolina, and I think the situation there is worse than many people in the nation realize, in terms of how much infrastructure has been destroyed. And of course, unfortunately, now the same thing is happening in Florida. So, will this have impacts in the U.S. economy? Undoubtedly. I think Raphael Bostic is right. I think what's interesting is that there's a lot of gives and takes when we think about a huge, horrific natural disaster with a huge human toll. We tend to focus solely on the negative sides of the economic impact, and for obvious reasons. The cold hard economic facts is that the gives and takes of what happens after a catastrophe like this are often there's often two sides of it, because yes, I think the supply chain's already struggling, right? We've had
Hmm.
we had the strike that was recently and probably only temporarily ended. We have increasing geopolitical issues across the world that are certainly going to affect commodity prices. All of those things are going to complicate the supply chain, I believe, and that's going to have negative economic impacts. The flip side to that, as it relates to recovering from a natural disaster, is there's going to be a lot of infrastructure spend in those regions in Western North Carolina, obviously in Florida. We don't know the overall toll yet in either of those places, but we know it's going to be grave. So there's going to be a huge amount of infrastructure spend, and so for companies, industry sectors that are construction related, that sometimes these things can actually be a huge stimulus of sorts in those areas, and that may, at least regionally, actually increase some of the manufacturing data that we're seeing. So there's a lot of like push and pull when a shocking natural disaster happens. For insurance companies, I get this question a lot. So I was actually talking to our portfolio manager yesterday, who's an expert in the insurance space. She used to work in the insurance space. And she said that what
Hmm.
often happens is it actually creates a hardening price cycle for insurers, which they take a huge hit on their balance sheet and income statement early on, but then because they're able to successfully raise prices, it leads to higher cash flows going forward. So understanding the pushes and pulls economically when something like this happens is often more complex than it seems at just at first blush.
Yeah, I've been talking a lot lately about insurance, especially in places that get hard hit by storms like Florida and Louisiana. The insurance picture is, there's a challenging market solution there right now, and
Hmm.
increasingly so in these areas. The rates, they are state regulated, so they basically ask permission to raise rates. So that's the hardening of the rates that you're talking about there. Um, but there's a lot of underwriting losses for subsequent years that keep happening in these states, and now we're seeing so many insurers leave the market. Do you anticipate any kind of changes that happen here where a state like Florida, more insurance companies would just be like, we're out, and here you go, here to the state insurer of last resort citizens, here's some more policies for you because we're not going to cover them?
Yeah, and I think there will continue to be changes, and I think sadly, in the end, the group that's going to suffer the most are the homeowners themselves, because as more companies flee that space, and as rates harden, it's going to only become more expensive to insure. So you take an area like Western North Carolina, it's not a flood prone area in general. It's
Yeah.
not like how parts of Florida are thought of. So what's really tragic is that a lot of those, homeowner policies don't have a lot of flood insurance built into them. And so, it's these types of situations. They always end up hurting the homeowners, in my opinion, and it's a pretty tragic situation.
Yeah, absolutely. Obviously, as we continue to talk about the economic impacts of all of this, we are thinking our, you know, pieces that we're seeing and saw there and impact, and then now on top of it, thinking about everyone right now and hoping that everyone is staying safe. There are some, static images that have been coming across. We saw the Tampa Bay Rays roof come off, and that was supposed to be an arena that was going to be sheltering first responders in the area. So see those kinds of areas. Obviously, there's also the port there in Tampa Bay, which will be affected by the supply chain. Do you anticipate that as we look at economic data in the next month, we're going to be seeing different changes? And what would those be, whether it be inflation or jobs? How are these disasters going to be impacting that?
I think in general, there's going to be a little bit of a concern around inflation. So of course, you sort of have this triple whammy right now of these natural disasters happening. Of we've already seen freight rates, shipping rates, get a lot harder, a lot more expensive here over the last few months. Even prior to this, we have labor unrest, as we talked about earlier, and then on top of that, as we look into areas like the Middle East and Russia, Ukraine, and these hot wars that are happening, that also has a potential to spike commodity prices. Now we're in a relatively fortunate place here in America where we produce a lot of the energy that we use. That wasn't the case in
Mm-hmm.
the 1970s, where we were much more reliant on oil from the Middle East. So our country's in a much better situation than it was, say 40 years ago as it relates to these things, but it's still going to have a concomitant effect that's going to ripple through the economy. And, the Fed is going to have to take it into account. One thing I think they would probably say is that many of these things are, well, they're certainly not going to use the transitory term anymore. I think that's been banished from the Fed dictionary forever. But I think they will say that these things are these spikes are short term in nature, that they tend to be
Yeah.
ephemeral, and that they don't represent structural changes. I think that's probably how the Fed will try to quote unquote look through these things. But I do think that heading into the back half of the last couple of months this year, that you could get a stronger inflation impulse from the confluence of all of these different things happening at once.
Mm-hmm. So as they go into November, do they need to be looking at the data prior to these storms as more realistic for where the country is?
I think they will be. I think just like a lot of us, they're going to be looking at the trend versus anchoring on any one specific data point, because I think that helps you kind of see the forest through the trees when you can kind of take a step back and look at the trend. But there's also a recency effect too, and you have to, in economic forecasting, you usually give the data points that are most recent. You give them a little bit more weight than data that's further behind you. That's generally how you tend to look at things, and so they're going to take these things seriously. They're going to have to.
Yeah. And again, I refreshed my CME Fed watch to see what the probabilities are. More and more climbing onto that 25 basis point bandwagon. So we're now at
Interesting.
about 12% saying one cut. And I imagine that's going to change. Of course, these probabilities flip pretty dramatically sometimes. We saw that before the Fed's 50 basis point cut, where,
Oh my
in the
gosh.
days
Yeah.
leading up to it, everybody was team 25 basis point. And it flipped very dramatically. And then, of course, we saw the Fed cut by 50. Looking back at that moment, cutting by 50 over there in September, did you think that was the right move?
Well, it's funny because I think you and I think I was on the show during that last
Yeah.
cut, and you and I were talking before the show started, and I think I said something to the effect of, I don't think they need to do 50. You know, I wouldn't be surprised if they do, but I don't think they need to.
Hmm.
And they did 50 anyway. I think the volatility around those probabilities is among the highest I've ever seen. You know, in the week preceding, and then directly after, the just the volatility and how those things swung around was just dramatic to me. And it's a reminder, I think, to myself and other practitioners: a, don't get too anchored on any one view. You know, our motto here at Riverfront is process over prediction, right?
Mm.
Humans, ourselves included, are always worse than we think we are at predicting. You shouldn't predicate your investment success on having a better crystal ball than someone else. And also the idea that as the facts change, you need to change as an investor. You need to be humble about what's knowable, and how much is unknowable in what we do. I think it's a very valuable lesson, whether you're at the Fed. The Fed certainly has had a lot
Hmm.
of learnings here in the last few years, or whether you're a professional investor or an amateur investor. I think you're always better off if you stay humble and recognize that the market's the final arbiter of who's right or wrong, not you or me. So, forecasting to
Hmm.
me is always a humble exercise, because it's constantly reminds you just how wrong you can be.
Yeah. The markets have certainly been on a tear recently. You anticipate that people will get a little bit more cautious right now. We have our warm inflation reports. We've got a hot jobs report. And we have, these natural disasters hitting on top of the conflicts that you mentioned abroad.
Yeah, let me speak in two time frames because I think it's instructive. To your question, the very near term, like where we are today versus where we'll be at the end of the year, I think that the market's going to get more volatile from here, and for a couple of reasons. Geopolitics are always, in the near term, have some level of effect on the market multiple, sort of the risk premium you place in markets. Generally, that market multiple change is ephemeral, meaning that geopolitical events rarely have lasting impacts on U.S. stock markets. But nonetheless, in the near term, that's going to swing it around. I think we have to recognize that not only is the election too close to call, but also it may be too close to call directly after the election, right? That we may not know on November 5th who won, the presidential election or Congress, because these things may be so close, and it may be a contested election. We have to, as market participants, we have to bake some level of probability in for that. And then, of course, these other issues that we're working through. Now you have to put that up against the seasonality of presidential election years, which is history is very has a very strong message on this, that November and December tend to be very strong months for the market, particularly in presidential election years. And then the
Hmm.
first year of the presidential cycle also tends to be a pretty strong year for markets. So in the very near term, I think volatility is likely to increase, because I think the market has front run maybe a little bit of the Santa Claus rally that people expect in November, December. I think we got that in September, right? September is typically the
Yeah.
worst month of the year, and we had a really good September. So we may have front run some of those gains, and there's certainly things that can make the market nervous between now and year end. But now, when you dial the lens back a little bit and you look in what I call the intermediate term, so let's call it the next 12 months, um, when you take a big step back, what we've got is we have a Federal Reserve in a rate cutting cycle with a robust employment market, an expanding economy. This doesn't happen that often. Um, and it's a little bit of a Goldilocks scenario for the stock market. You've got easing financial conditions at the same time. You have a market and an economy that's not falling off a cliff. Usually, the Fed is cutting interest rates because something has broken in the economy. And
Hmm.
so this is a relatively rare instance. And in the times in history when you get a rate cutting cycle without without an economy that's on the precipice of recession and a stock market that's close to all time highs, historically speaking, that's been a good backdrop to invest over the next year. So I would say that my very near term view is a little more cautious, and my intermediate term view at this juncture is still quite constructive on stocks.
I'm really glad you brought up many of those points because it's hard to conceptualize maybe what people are feeling in the real world, their purchasing power, and more versus what we're seeing with the economy, which is that it is a Goldilocks scenario. And you say that it's rare, but it's nearly, it's nearly unheard of for the Fed to be able to bring down inflation without triggering a recession. And we've got GDP at a 3% clip right now. So things are chugging along to your point. And then that surprise jobs report that we just had as well. And many sectors contributing to that. So it wasn't like just a bunch of government jobs that were, adding on to the economy. So certainly an interesting economy that we're here to cover. I just want to wrap it up by discussing what we saw from our inflation report, which is that for headline inflation numbers, we're looking at 2.4% rise in prices over the year. This is for the consumer price index. For core, which strips out the volatile food and energy prices, especially that energy price, which is impacted by all of the things happening around the world. Core inflation at 3.3%. So certainly higher than what the Fed wants to see. And I'll just add this caveat is that we look at the consumer price index first because it's the first one out, it gets the most attention, and we get the first measure of what inflation has been for the prior month. But the Fed prefers the PCE price index, which they find to be a little bit more reliable for their purposes. So that's where we're sitting with inflation today. Chris Konstantinos from RiverFront Investment Group. I really appreciate you coming back on to talk with us. We had a lot of fun when the Fed did their 50 basis point supersize cut. And now, we've got a report that is almost what was expected. So I appreciate you, Chris. Thank you so much.
Always a pleasure, Simone. Thanks for having me.